Okay, here we go. Okay, listen. Unfortunately, I have to start with this disclaimer. But all signals and trading opportunities provided both orally, written or electronically that are disclosed are for educational demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures or forex markets or for any profits or losses that may be incurred. I just want to remind you that we're not certified, that we're not licensed commodity trading advisors. You should always consult your broker. Never risk more than 2% of your account on any given trade. And with that said, let me roll ahead here. Just a little bit about myself, and I want to move. I have a lot of material to present to you, and also I'm going to go a little bit quickly. I'm a graduate of the University of Pennsylvania, former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for 20 years. In fact, I think I started trading stocks 25 years ago. Began trading futures and forex about 10 years ago. Now, in my graduate work, what I did was I was involved in the optimization of closed systems via mathematical modeling. And what we look upon here at Right Line Trading as every financial market as being a closed system. And every closed system is defined by a series of independent variables. And what they define is how that system is going to behave. If you're looking at a financial market and you understand the independent variables or the forces that are brought to bear on price in that market, then you can predict with a high degree of certainty how price is going to move out into the future. It's really all based on math. Now, the problem with current technical analysis is that 95%, we all know that 95% of day traders fail. The problem is that there's no evolutionary process that takes place among day traders or swing traders. That 95% failure rate never seems to improve, and there's a reason for that. If you're an architect starting out, say, 1,000 years ago, and 95% of the buildings that you put up fell down, what happens is that scientists look at all the principles that you used to erect the building, and via very, very analytical studies would then determine which of those principles did not work and remove them, and determine which of those principles did work, and they would magnify them. So over the course of time, the failure rate would slowly diminish, and eventually almost 100% of the buildings that you erected would be successful. That does not take place in the day trading and swing trading arena. Unfortunately, even people in finance and huge universities that have large business colleges don't have a division of technical analysis. There's really little science that is brought to bear on few studies that are done to determine how well an oscillator works to help fine-tune your entries, how well a MACD works. So basically, each generation of day trader just simply turns over to the next generation the same fundamental technical analysis, the same series of indicators, and the next generation just fails. So the idea is, don't ever accept current dogma without mathematical verification. And if you do a Nexus Lexis search of the world literature, you're going to find almost no information published as to the sensitivity and specificity and predictive value of a given entry based on almost any indicator that we use. Now, what we've done is we've done our own analysis and our own mathematical studies, and what we've determined are that they're independent variables and they're dependent variables. Now, if you trade an oscillator, you all know how bad oscillator divergence is for predicting a high or a low. It gets run over constantly. In addition, there's two groups of traders that use an oscillator. when an oscillator is overbought, one group of traders continue to buy because in an overbought market, the bulls are in control and they're going to buy each unbroken pivot to the upside, while the other group of traders looks for divergence and looks to fade the market. Now, the MACD is really an elegant indicator, and the formula is really, I think, really elegant. But the MACD and both the oscillator really do a great job of telling you where the price has been, but they have no ability to predict where price is going to be in the future. Now, Fibonacci was an 11th century mathematician who created Fibonacci transformations, and from those derived his Fibonacci numbers. Then 900 years later, somebody got the idea of taking his retracements and extensions and putting them into the financial markets, and that somehow they would have the power to predict where price on any financial market would move out into the future. We looked at the ability of Fibonacci support and resistance to predict future price, and it just has almost no ability. And one would not assume that it would have any ability. And ultimately, when I show you what really matters in terms of determining the direction of price out into the future on any market, on any time frame, and it doesn't matter whether it's stocks, futures, or Forex, you're going to see why Fibonacci just has no validity. I mean, generation after generation of day trader find it somehow tremendously appealing, but it really doesn't have any validity in day trading. Classic Elliott wave, at least Elliott was looking at the financial markets when he created it, and I've read lots of books on Elliott wave, and again, it's a really elegant theory. Unfortunately, it just doesn't translate into the real world. And what really makes a difference in determining where the future movement of price is going to be are these independent variables. And the first is making an assessment of the multi-time frame analysis of trend. The other is the multi-time frame analysis of correlative markets, which is in essence money flow. We want to know when the institutional players are involved in the market, and we want to know which direction money is flowing. Now, there's a lot of software out there that says that they can track money flow, and a lot of traders who say they know how to do it, but I'm going to show you the system. None of it's black box. I'm going to show you how we track money flow. The other is the multi-time frame analysis of order flow. We want to know where's the predominance on the dome. Is there a predominance of buy orders on the dome, or is there a predominance of sell orders? We also want to make a multi-time frame analysis of momentum, and then finally we want to leverage market profile on a multi-time frame basis. These are all the independent variables that our algorithmic auto trader requires and analyzes in order to take a trade. I'm going to go through them with you one at a time. I'm going fast because it's a lot of stuff. Now, there's a lot of ways to assess momentum. And you can use an oscillator, you can use a MACD, but what we do is we use a modified Heikin-Ashi formula. And the top line is the analysis of momentum. It's called our three-line indicator, but we eliminated the stochastic line because we found that a bounded indicator like this stochastic, as I mentioned, does nothing to increase the precision of your trading. It will just degrade the precision of your trading. So over the course of years, the three lines become the two line, but we still call it the three line. The upper line is momentum, and what it does is it assesses the direction of momentum on the two higher time frames that you trade, and it ignores your trading chart. So if you're trading a 3-minute, it's analyzing momentum on the 9-minute and on the 27-minute. Now, if you're trading a 5 range, it's analyzing momentum on the 8 and 13 range, and those are Fibonacci numbers. Now, Fibonacci has really nice symmetry. It just can't predict where price is going to move out into the future. If you're trading a 377 tick, it's going to analyze momentum on the 610 and then the 9 something, whatever that next fib number is. So it ignores your price on your trading chart, just doing all its analysis on the 2 higher time frames. Order flow is the same thing. Now, order flow looks at whether there's a predominance of buyers or sellers on the dome on each individual candle, and that creates a delta. Every candle creates a new delta. What we do now, analyzing a single delta is not going to help you because you can have a negative delta on a positive candle. So what we do is we take the delta of each candle, place it in a 15-period moving average to smooth it, to give us a very, very accurate assessment of who's in control of the market at any given time. Is there a predominance of buyers in the market? Is there buying pressure? Or are there predominance of sellers on the market? Is there selling pressure? And we only look at the 2 higher time frames again. We ignore what's going on your trading chart. That's what makes these independent variables. When you start using data from your trading chart, these then become dependent on the direction of price on your trading chart. We don't want to do that. We only want to look at the 2 higher time frames. So since these are 2 equal forces that create pressure on any financial instrument or price on any financial instrument to move in a particular direction, they must be aligned for the auto trader to trade. So the multi-time frame assessment of Heikin-Ashi momentum and the multi-time frame assessment of order flow, which is simply a moving average of the delta on the 2 higher time frames. When they're both green, price on your trading chart is almost always going to rise. And remember, these are ignoring price on your trading chart. Price rises on your trading chart because they're green. They're not green because price is rising. That's what 99% of all the other indicators do. They simply tell you what you already know, and they have no future predictive value. So when you break support or resistance here, you've got to trade long, and you can see all the traders taking in these orange candles trying to counter trade against the direction. It's the same thing here. Now the time frame's irrelevant, the instrument's irrelevant, the market's irrelevant. All that matters is that you have order flow and momentum aligned, and the only possible direction that you can trade is long. This is what the auto trader, the algorithmic auto trader, is assessing to determine what direction it wants to trade. It will not counter trend trade, but if you wanted to counter trend trade, you would have to wait till these 2 independent variables reversed. Now, what happens when they're not aligned? In this particular case, you have momentum to the upside and momentum to the downside, order flow to the upside. That's why the market chops. When these forces that create the future direction of price or don't align, price is going to then chop. When they come into alignment, price is then going to trend. So when you get these 2 that are not aligned, that's when the auto trader is going to stand out. The same thing again. When momentum is aligned to the upside and order flow to the downside, you're most likely to get chop in price, and the auto trader will not trade. It's going to wait until there's a break of resistance to the upside. There's alignment in these 2 independent forces, and price will rise. Now, this multi-time frame analysis of trend is one of the most important independent variables, I think, that are out there. What the system is doing is looking at the trend of your 2 higher time frames, just like the last indicator looked at momentum and order flow direction on your 2 higher time frames. Again, it's totally ignoring your trading chart, and it's simply looking at the trend If you're trading a 3-minute, again, it's a 9 and a 27-minute. 5 range, it's looking at the 8 range and the 13 range, the 2 higher fibs. We trade the NASDAQ on a 13 range. It looks at the 21 and the 34 range. And what it's looking at is the slope of the 50 period moving average and the slope of the simple 50 and the slope of a proprietary 15. When the 50 is sloping down, when the 15 is sloping down, and the 15's crossed the 50 to the downside, and price is below the 15 and the 50, so support's been broken on the 2 higher time frames, that's when the background bias on your trading chart turns pink. And it provides an absolute trading direction for the algorithmic auto trader. It must trade short because you've broken support on your 2 higher time frames, and your 50 and your 15 are heading down, and the 50s cross the 15 to the downside on your 2 higher time frames. If you try to counter trend trade the market, the likelihood of getting stopped out is exceedingly high. This is the same thing again in the opposite direction. Now this is the E-mini. This is 14.25 points. This is 11.75 points, and the size of the move is irrelevant. What I wanted to show you is the only direction you can trade when the 50 sloping up and the 15 sloping up, and the 50s cross the 15 to the upside, and price has broken all resistance to the upside and is above the 50 and the 15 on your 2 higher time frames, the only direction that you can trade is long, and that's the direction that's going to be set by the auto. So when you have order flow and momentum aligned to the upside, you have the multi-time frame, when you have the multi-time frame assessment of trend aligned to the upside, you're now getting more and more specificity in determining the absolute direction you must trade in order to get a winner. Now here's how we track money flow. In any given market, on any, and I'm moving too slow because I want to be able to answer some questions. On any given market, on any given day, you know that the amount of money in the market is pretty fixed. Now, I mean, there's money inflow and money outflow, but for the most part, it's the same amount of money moving in the market. Yet different instruments go up and different instruments go down, and what is taking place is that the large institutions are moving the money from asset class to asset class. Now when risk is off, they're going to move their money out of stocks like the NASDAQ, the E-mini, the Russell, and the Dow, and they're going to move their money into safer trading instruments like treasury notes, treasury bonds, certain currencies, and certain precious metals. So what we have are markets that are directly proportional. When the E-mini moves in the same direction as the NASDAQ, the Dow, and the Russell, and we have markets that are inversely proportional. They moved up when these move down. And what they're doing when everything aligns appropriately, they're tracking the flow of money out of stocks and into safer investment vehicles. And if you take a look here at bonds, now the auto does not trade bonds, and this is an older slide when it did. When money is flowing into bonds, like one of the correlative markets is treasury notes. So when bonds go up, notes go up, and there's 6 markets here. Some of them which correlate directly, and some of which correlate in the inverse direction, as I showed you. When they're green, it means that money is flowing into bonds and its correlative markets, and flowing out of the markets that are inversely correlated with bonds. It defines the fact that money, there's an asset class rotation of money into bonds. And when it's green, bonds are going to rise. And this indicator does not even assess bonds. It's assessing 6 other markets. Now, when there's no money being rotated in a definite direction, the market tends to move and chop, and the auto trader will stand down. And here's another example. I showed this to you before. When the institutional traders start creating start pushing huge amounts of money into the E-mini, and you can see it with these 3 green lines. There are 9 correlative markets on the index equities, on the index equities, the E-mini, the Russell, the Dow, the NASDAQ. They rise. They also tend to create that multi-time frame alignment and trend, and they're also going to create that alignment of order flow and momentum. Now, market profile is really important. It's based on really, really powerful math. Now, in a perfect world, any set of data that was randomly distributed would create this bell-shaped curve. Unfortunately, this isn't a perfect world, and so the data for market profile is rarely bell-shaped. But if you look at price and volume, this line here is the point of control, or the price at which most volume crosses and at a specific price. And this is the value area that traders want to keep the trading instrument within. And to make it easier for you, this fair value area, or fair market value area, encompasses 66 2/3% of all volume at price. When price approaches the value area high, it's going to get pushed down. When it approaches the value area low, it's going to get pushed up. The point of control is where most volume crosses at any given price. And the point of control is really a great line to avoid. You don't want to trade into it. And it's a great line to trade off of when it's acting as support or resistance. You get great trades. So there's an additional factor. There's low volume nodes, which are the opposite of the point of control. The point of control is where most volume at price is crossed. Low volume node is where almost no volume at price is crossed. And this creates these zones of rejection, which the algorithmic auto trader recognizes. It will not take a trade up into this resistance, nor take a trade down into this support. And you can see what happens here. Price comes up, it's rejected. Price comes up, it's rejected. And then it falls. It breaks support. But when it comes up to resistance, you got a great short trade. Now, you have that trade because the 15 and the 50 are down, but we're not looking at the multi-time frame assessment of trend, order flow, momentum, or money flow. Now, here's just putting 2 of these variables together. Here's order flow. When you break support and order flow is red, you can only trade short. Remember, this is an assessment of order flow on your 2 higher time frames. When you hit support, this is the point of control, which gives you great trades, and order flow is green, you can only trade long. And then when you break the support of the point of control and come up to test it as resistance, and order flow is red, the only direction that you can trade is down. Now, we've gone even further. An intra-candle, we create a market profile. And this yellow tick level is called the commitment of traders. It is the point of control, but it is also called the COT. On a long trade, when the commitment of traders is at the bottom, you've got yourself a great long trade. On a short trade, when the commitment of traders is at the top, you have a great short trade. The algorithmic system watches where the COT is on each individual candle at each potential entry and looks to only take an entry when that COT is in the lower 1/3 of the candle on a long and in the upper 1/3 of the candle on a short. All of these are creating more and more specificity. It makes it more and more difficult to get a trade, but we don't want a lot of trades. What we want are a lot of winners. Here's the same thing. This is I label this as the POC. It's not. It's the value area low. Price comes down to the value area low. Look where the commitment of traders is, right at the bottom, and up you go. Now this is the volume weighted average price. It also assesses that as an area of resistance or support and makes an assessment whether this is going to be broken or hold based on the level of the COT going into it. So if the commitment of traders remains at the bottom of the candle, it tells you that the buyers are firmly in control and that resistance to the upside is likely to break. And here's just one more example. Now the cash metrics is an indicator you'll never see anyplace else because we invented it. And what it is it's 16 indices, not 21. We got rid of 5. And what we do is we take those 16 and we break them up into 4 groups. 16 for the Dow, 16 for the NASDAQ, 16 for the S&P, and 16 for the Russell. And here are just some of them. This is the instrument manager. And it uses the semiconductor index. It looks at ETFs. And what it does is it looks at the rate. Some of the things it looks at is the ratio of up volume to down volume, the ratio of advancing issues over declining issues, the ratio of upticking stocks to downticking stocks, the ratio of advancing declining issues for specific ETFs. For instance, if you're trading the NASDAQ futures, what really moves? The NASDAQ is a market cap weighted index. If Google, Apple, Facebook, Amazon, these big caps are advancing, they have tremendous throw weight on the direction of the NASDAQ. So what it does is it's honing down and looking at cash market fundamentals. But what we do is we use these and leverage these when we trade the futures market. So we actually have a stock data feed active on our futures market. Now, if you think about it, if you're going to take a long trade on the NQ futures market, wouldn't you like the cash internals to be in your direction? Isn't that going to make the likelihood of a winner on the NASDAQ greater? If you're trading the S&P 500, the E-mini, wouldn't you want the cash internals on the S&P 500 to be aligned in the favor, in the direction of your trade? If they are, the likelihood of a winner is far greater. If you're trading against these internals, the likelihood of getting a loser goes up dramatically. Now the upper line is evaluating the 8 tick data metrics, and the lower line is evaluating the 8 volume data metrics. Now the auto trader isn't active on stocks. We're looking to do it on stocks, and these are stock examples. I want to move through them really quickly because I don't want to run over. So here's the NQ, and here's the cash metrics. So the internals on the NQ, cash markets are strongly to the downside. So if you take an NQ futures trade to the downside, the likelihood of a winner is far greater. Now, the algorithmic system watches the cash metrics. Here's an E-mini, cash metrics aligned to the upside, 9.25 points. Now, this is market open. This is not an algorithmic setup. Now, what are the entries? Everything that I've talked about up till now has all been about direction. How about an actual entry? The first entry that the algorithmic system takes is called the strategy entry. Now, these are not dumb entries, they're smart entries. A dumb entry just takes an oscillator crossover, a MACD crossover, or the combination of the two. What this does, it does a multi-time frame of assessment of price action and market structure. It's only going to trigger a short when the 15 and the 50 are in the appropriate direction on a multi-time frame basis. The algorithmic is going to look at it, assess every other independent variable. If they're all aligned appropriately, it will trigger a short trade. Here's a strategy to the long side and a strategy to the short side. Again, this is when the algorithmic looks, these fire intra-candle. If everything else is aligned right, the multi-time frame alignment of trend, order flow, momentum, money flow, the cash metrics, they're all perfect. You're going to get a long trade triggered or a short trade triggered. Now, the ABC entry is the only entry we have in which the entry itself is only based on a single time frame. And it's simply a move down. The software creates the A. We look for traders to trade in the counter trend direction. They're trading the oscillator divergence, MACD divergence, the stuff that comprises the technical analysis that causes 95% of day traders to fail. What they're doing is they are calling a bottom here when there's absolutely no reason to assume that the market is bottomed out. And they almost always get run over. The system looks for a potential C engulfing candle. It's going to set the short entry one tick below the close. If the candle evolves, down you go. It'll only set that entry if everything else aligns. And if the candle does not evolve to the downside, it cancels the trade. It self-manages the entire trade entry. And I want to just talk about that for 1 second. So I want to talk about stops and targets. Stops are changed and targets are changed based on the average true range of the instrument at the time that the entry, at the time that the trigger is created and the entry is made. If there's a lot of volatility in the markets, the auto will set 3 targets for you fairly far out to try to milk that volatility. If the market is docile and quiet and volatility is dropped, then it's going to bring your targets in. It's going to give you a better chance on a statistical basis of getting all 3 targets out. So the trade is entirely self-managing with your stops and targets all modified based on the average true range or the volatility of the trading instrument at the time that the order is placed. Here's another C candle entry. Another C candle entry. Now, I'll mention quickly that the reason these are so powerful is they're pushed down by 2 forces. One is the addition of new sellers, and the other is by the fact that all these counter trend traders are stopped out. As the trade matures to the downside, pain tolerance gets greater and greater in these counter trend traders, and they eventually start closing their positions and pushing this trade in the direction you want it to go. The consolidation entry is my favorite entry. The software creates this channel. The consolidation signal fires. It's a multi-time frame assessment. It's going to tell you when consolidation is going to break, and it's going to give you a great trade. Consolidation is an area where volatility is dropped, and you get the power of the bulls equaling the power of the bears. Almost all systems will allow you to get in on the next candle. We get you in before consolidation breaks. on the anticipation because we're making an assessment of the two higher time frames. It's an exceedingly accurate entry. There's another one, and there are two more. Now, these are Facebook, Wynn Resorts. Here's the E-mini for 3 1/4. Everything's aligned with pink background bias. What I really want to do is I want to get you to a live market. Now, we don't have the automated system on the Forex, but you can see when everything aligns and you take it manually, it's 43 pips for 655. Here's 52 pips for 610. When money flow, order flow, and momentum and everything aligns, you wind up getting a great trade. If the principles that govern the future movement of price are accurate and true, they are market independent and time frame independent. If you're looking at a system that just works on stocks, it's broken because there's nothing unique to stocks. It's simply a financial instrument and a closed system. If it doesn't work on stocks, futures, and Forex, and if it doesn't work on all time frames, then the principles that are used to determine the future movement of price are not accurate. It does not make any difference what you trade here. Now, on the auto system, we only trade 8 futures markets, and I'll show you what they are. I'm just going to move through. This is Tesla, Apple. Here's I put in 2 testimonials. This is Jersey Tony. He's been with us for 2.5 years. He's a top step trader. I only put in the top step trader testimonials because their performance, even though their name is not attached, is public. And he makes a ton of money with us. D. Moore is right here. He was in the $50,000 combine. He made more money than anybody else in the country in 2016. He trades our system. We have a huge number of top step traders in our trading room. He went 21 straight days without taking a loss. And his first paycheck, which came really quickly after he got funded, was $3,000. So what we're looking at is the bias. I'm not really going to review this. What I do want to show you, though, if I can get this right. Hold on one second. I want to show you the results of the auto trader. Now, Sergio had to go early today, so I cannot show you this. It's not up to date, but it's close. And those are our live trades. I'm just going to bring up Google. All right, what's not found, which doesn't matter. I will get it for us. Here's our algorithmic trading system. It's our website. Go to learn more. And here's our algorithmic performance. And here's our results. And we try to post them daily. We're just a little bit behind. Here we go. Now through 11/6, the auto traders made $28,677.38. Now it started with $5,000 in the account, but we actually started the profit at 0. We got our cumulative profit at 0, and our first trade was $180. So that $28,000 is profit made out of a $5,000 account, not including the $5,000. Let me drop that. I'll just put it over here, and then what I want to show you, if I can find it, and that's my son in the background, is this was downloaded from NinjaTrader's back end. You can export your back end directly looking at the results. And the results, we made $1,331.25 in 2 days. And that's not including today, which I think we made about $375. Let me put these back. Let me show you the offer before I run out of time. But only got 2 more minutes, and then I'll see what I can do in terms of questions. But here's our offer: is the Automated Algorithmic Trader. 3 months in the trading room with me. I'm in there every morning. We trade live on the right edge of the chart. We have 400 videos in our video tutorial library. Now, the system today is active on gold, crude, the E-mini, the NASDAQ, and the 6E. Next week, it'll go live on 6B, 6C, and 6J. It's $1,899, 1 payment, $999, 2 payments, 1 month apart, and the first 5 only will get the 6B, the 6C, and the 6J as a free add-on. If after that, you're going to have to pay for these additional markets. And here's our phone number: 786-713-5276. I'm going to show you one entry on the algorithmic system. They're easy to spot. If I can, just when I tell you they're easy to spot, I can't find one. Hold on 1 second. And then I'm only going to have 1 minute to answer questions. You know what? They're not coming up on the N cube. Hang on 1 second. Let me show them to you on my E-mini. The E-mini is much easier. Right here. That was yesterday. Here was the entry. Every line was green. Now, fractal analysis, when you close and open Ninja, changes the color of these lines. And not every line has to be green. The auto trader has some discretion. We had order flow, the major quant, the minor quant, so money was moving in the direction of the instrument, of the multi-time frame assessment of trend. We're trading off the point of control. The trade actually went up more than 4 3/4 points, but that's as much as the auto trader made. So I just wanted to show you one trade in a live market. And now let me see if I can answer any questions. But you'd be up well over $30,000 if you started trading it at the beginning of the year. Hold on 1 sec. Okay. David, the ratio is winning to losing is about, it trades between about a 75 to 80% win rate. Larry, we enter within the consolidation area and not wait till price breaks out, because by looking at the 2 higher time frames, we can make an assessment that's very accurate of when consolidation is going to break. Vishal, on that 30,000, early on for the first year or so, we traded 2 contracts, and then when we saw how accurate the system was, we went to 4 contracts. So on average, it's about 3 contracts on each of the instruments. Now, and the only thing I'll say to end is that what we do is every 3 months, we fine-tune the system. If I went through the system very slowly, you would have seen that we take it offline. We used to trade bonds and notes. Those markets stopped performing. We kicked them out. The currencies are trading great. That's why we're adding 3. This is always in a state of flux. We're always looking to improve it. Remember, we base it on the optimization of a closed system. The optimization process is never done. We're always looking to make it better, and we're always making a reassessment of every single market. And if one stops performing or changes the way it's moving, we get rid of it. And we look to bring in markets that are going to perform the way they should. So it's a constant assessment and reassessment. So literature, everyone, thank you so much for giving me your time. I don't want to run any further over. And thank you so much for having me. I really appreciate it. Take care, all.